Well, the decision itself isn't a surprise, David. The why, though, is a good question. I don't see really an argument for cutting the funds rate, particularly given the Fed's own macroeconomic forecast that would have real GDP growth now higher next year, not lower. There are reasonable minds on both sides who are debating the employment trade-off and the inflation trade-off. More interestingly, going forward, what could the Fed do? I don't see rate cuts. If you look at the Fed funds rate now, it's roughly in the range of where it should be, given views about what the real federal funds rate is and the inflation forecast the Fed itself has put out. So I don't see much more room to cut.
If you believe the Fed's projections, next year in 2026, they took up the GDP growth by 0.5%.
That's big.
When do you cut rates into a growing economy?
Well, I think they would have to argue that it's about employment, not just output, but that seems very tortured as an argument. They still have time to react to labor pressures should they worsen. Remember, the Fed also lowered the unemployment rate for next year as well. That doesn't look like an economy heading toward recession. Now, I'm not saying that will come to pass, but that is the Fed's view.
Artificial intelligence is all the talk of the town, including with Chair Powell in his decision this week. How can the Fed understand AI well enough to know what that will do to, for example, productivity, which the chair talked about?
Well, I don't think any of us, if we're honest, know. When I talk to business people in California, they're extremely optimistic. Every CEO is optimistic. Some others are more dour among economists. Honestly, I think there's every reason to believe generative AI could be a big productivity boom, but therein lies the rub for the Fed. If you think AI is the future of productivity, that's a story for higher, not lower, interest rates. The real interest rate will go up, and inflation is still stuck at a higher level. If we're wrong about AI, then we've got many things to worry about because we have a lot of CapEx going into AI data centers and things like that. But I don't think the AI productivity story gets the Fed to low rates. This is not a replay of Greenspan in the 1990s.
What sorts of pressures could AI, in success with increased productivity, increased investment, as you say, put on the dual mandate? Because you could have, on the one hand, said growth, economic growth, increased productivity dramatically, with lower employment. So you could be on both sides of that mandate.
You well could. At the moment, I'm not so sure. So we have seen, obviously, a weakening labor market, but I'm not sure AI is associated with it. When you look at all of the sectors that are weakening, to me, it looks more like an unwind of excess hiring during COVID. So we don't yet know. And we don't know going forward, is AI going to be more of a complement to you, me, and everybody else in terms of the skills we have, or a substitute? But if it were the case that AI displaced a lot of jobs, to me, that's less of a Federal Reserve challenge and more of a government challenge, that the government needs to do something, have a policy to prepare people better than we did in previous waves of technological change.
One of the things that Chair Powell addressed was tariffs. When he was asked about the elevated, well above the 2% number in inflation, he said, well, that's really a tariff thing and we think that will dissipate. Is he right about that?
In principle, yes. A tariff is, if you had a once and for all tariff, that should raise prices, not inflation. It only raises inflation for a period of time. The problem is we've seen tariffs come, tariffs go, rates go up, rates go down, so it becomes a little harder. My worry about the tariffs is less about inflation, somewhat for the reasons Chair Powell has suggested, but more for their long-run corrosive effect on the economy in productivity, in supply chains. You know, again, America's imports are more than half of them are intermediate goods. We're shooting ourselves in the foot whenever we do large across-the-board tariffs.
What do you make of the fact we're now up to 3 dissents? 2 going one way, 1 going the other way. We went for a long time, actually, with essentially no dissents in the Fed. Is this a good thing, a bad thing, or something in between?
I think it could be any of the above. So it's a good thing in the sense that in a healthy organization, if you and I don't have the same view, we should speak it if we're not going to be reconciled. That said, you've got to ultimately govern the Fed. We're about to have a new Fed chair. The president will tell us who it is sometime in the near future. And that gentleman or lady is going to have to bring together a group of people with disparate opinions. That's where the challenge seems to hold. Chair Powell has done a very good job, I think, in managing through a situation where people could reasonably hold different views about the economy and obvious political cross currents. He's been able to get through that. The new Fed chair, whoever it is, will face that challenge.
It's one thing to have disagreements over policy, over theory, even over what the data are telling you. It's another thing to have political disagreements. We tend to think that the Fed should stay away from political disagreements and disagree over the merits, as it were.
Well, that's absolutely right. You can make a case right now in the economy for different points of view about the path of interest rates. The fact that I have one point of view does not mean, for example, that Governor Waller's wrong, because he has a different point of view. He has a different way of looking at the world. I respect that. If your argument is based on politics, then that's not a technocratic argument for the Fed. Political arguments are fine when you're talking about fiscal policy or things that the Congress does, but the Fed was set up to provide independent judgment about monetary policy, and that's what it should do.
To provide independent judgments and to be perceived as providing independent judgments.
It's critical, David, because if people don't believe that you're independent, even if you yourself think you are, that doesn't work. And you have to ask yourself, why does it not work? The bond market and capital markets depend on the perception that the Fed is an independent agency.
One of the things that came up more than once in the news conference, although Chair Powell really refused to address it, is the question in Governor Cook's case, pending before the Supreme Court. If you had to choose, which is more important, who the Fed chair is or how the Supreme Court rules?
Well, I'm going to give you a non-lawyer's answer because I don't know, but to me the Cook case is very important, and not just because it's about Governor Cook per se, just call it about X, whoever X is. If the president can fire a member of the Federal Reserve Board for what doesn't appear to be cause, at least as an outsider, then that speaks volumes about the Fed's independence. So I think that case is one to watch. I'm not a lawyer. I don't know what the outcome will be, but I wish the Supreme Court well in deciding it.
Looking forward into 2026, which is very, very difficult, obviously, do you think there's more risks to the upside or the downside in the economy?
I see risks in both directions. The AI boom that we spoke about is clearly an upside risk. To me, the resilience of the economy is also an upside risk. If we were having this conversation a year ago and you had told me about Liberation Day, I alone got to know that, I would have then thought the macroeconomy would do worse than it did. I would have predicted market effects, which did happen, but not the macroeconomic effects. And I think part of that is the overwhelming resilience of the American economy combined with the productivity boom. I think those are real upsides. The downsides I would worry about is that the labor market could weaken gradually then suddenly. And we already have a credit cycle that looks relatively mature to me. And so I would start to worry about credit accidents, which could affect the bond market. So that would worry me as a downside. And then, of course, there are always geopolitical risks that I'm certainly not an expert in and are hard to predict. So I think there are risks on both sides. It's going to be a very interesting year for the Fed, for fiscal policy, and obviously because it's an election year, a highly charged year.